Back to another video. Today we will be talking about what I think is the best option strategy for any beginner out there who wants to get into the market game. Now, the reason why I believe this is the best strategy is because of the very minimal risk that is entailed. So there is many option strategies out there, although this is what I can see is one of the lowest risk to reward ratios that you can get in any options trading. So today we'll just be looking at Snap just because it's at a good price where a lot of people can essentially afford these options. So options are dealt with through contracts, and contracts are 100 shares. So whatever the share price is, you're going to have to buy 100 if you get assigned the shares. Now, I will get further into this, although these are called cash secure puts because you are secured by the cash that you have in the brokerage. So the lower the share price, the cheaper it is. The higher the share price, the more expensive it is, of course. So I will be using Robinhood. Typically, I like to use TD Ameritrade and Robinhood. It really depends on what kind of option strategy I'm going for. Although I know that a lot of people who are watching my YouTube videos typically deal with Robinhood, so I just want to make it easy and show you guys a good visual. So I go here to the trade options, and now if you don't have trade options trading, aka level 2, you're going to have to go into your account and request it and do a couple other things. But you guys can figure that out. Just search it up in Google. So as we go here into the trade options grid, you will select sell and sell a put. Okay, so then you will have to look at the expiration date. So today is January 8th, and it's a Friday, so it is or was an expiration date because typically they deal in weeklies. It depends on what security you are trading options on, but some have one per month, some have one per week, and then the SPY ETF has like 2 or 3 per week. But I will select this one, January 15th, which is a week out from today. And now Snap did close at 52.62 for today's trading day. And you need to keep that in mind because, of course, the options or the derivatives are based off of the stock price. So I'm going to drop down and say that Snap is a very good company. To be honest, I have not researched it, but I'm just using this as an example. And I have a very good outlook on Snap's future, and I would like to invest in them. And I've done my due diligence, and I believe that Snap is a good buy at $50. So if Snap does drop to $50, just like normal trading, like a normal trading day, like here, let's say I want to take a long stance for 100 shares. So I'm going to drop basically $5,000 into Snap as an investment. So you could do that, but while you're waiting, you're not making any money. You're just sitting on this cash, and cash is trash for the sole purpose of making money because cash is an asset that is losing value in the modern day right now. So I'm not saying cash is always trash, but I don't want to sit on a lot of cash for a long time. If Snap doesn't drop to $50 for the next year and a half, I don't want to be sitting on that because I'm losing out on opportunity cost from the interest that I could have made in basically any security that I would have invested in. So let's say I want to make some money while it's sitting there. Okay, so I'm going to sell a put at, let's say, a week out for expiration, and I believe Snap is a good buy at $50. Okay, so what you do here is you can decide how many contracts you would like, but you're selling a put, and as you can see here, my total credit is for 47 cents. Now that is deceiving because options deal in contracts. Contracts are 100 shares of the underlying security, or Snap in this case. So you would have to take 47 cents and multiply it by 100, which equivalent equals $47. So there's two possible outcomes to this option trade. It ends on the trading day of January 15th, Snap's stock price, your stock quote, above $50 or below $50. Now, if it is at $50, that is considered above for this example. So if it is at $50, it is looked at as below because $50 is the agreed upon price. So what is an option? An option is when two traders decide and agree upon some terms. So when you are dealing with these, I am a seller of this put option at $50, and I'm agreeing upon that if the stock price goes to $50 or less, I will buy 100 shares. But if it does not get down to $50 in the next week, let's say it goes up, it goes down a little bit to 51 from 52, doesn't matter, it stays above 50, I'm telling him that he has to pay me $47 just to write this option up and agree upon it. So no matter what happens, I get $47, okay? So if it is ending above the $50 price, I will collect my $47 and take back my cash. No harm, no foul. I just profited $47. And then you can roll this over to the next week and do the exact same option. Maybe you tweak the strike price or whatever. But that's it. You make $47 and you walk away with cash. You win. Now, what if you, quote unquote, lose? Well, you don't really lose. That's a beautiful part about this option strategy, is if it does hit $50 or below, that's all right, because you, again, believe in this underlying security, Snap, in this case. So you do collect your $47 at premium, so you pocket $47. No harm, no foul there. So you're up $47, but you had to buy the 100 shares at $50 per share, which is fine because you believe in the company. So you just basically bought 100 shares of equity. That's it. The only way that you necessarily lose is if you buy it at $50 and then your analysis on the company is poor and it begins to dwindle. But if you buy the security anyways at that price and it begins to dwindle and continues to dwindle, well then that's all right because you would have lost anyways. But another key factor is as you're collecting this premium, you're lowering your cost basis. So the $5,000 is not actually $5,000 because you have to subtract the money that you made from it. So it's $47 less, or $4,953 for 100 shares, which it would have been $5,000. Now, hold on to that for a week, a month, however long you want to hold on to it. Honestly, the next trading day, it could pop back up to $50.50. Okay? And then you can sell and make a profit off of the shares that you were assigned and, of course, collect a premium. So you don't really lose in this situation. All you do is just buy it at $50. And as the price continues to fluctuate, you can continuously put this trade on week after week. Now, you can decide how far you want to go out. The farther you go out, it is less risky. You are less likely to be assigned shares. But you also get a smaller premium. The closer to the money, you get a higher premium. As we can see here, the $47, as we inch closer, goes up to $59, $73, $90, $110, $135. So the closer you get to the money, the more premium you will make, although the lower chance of being the stock price ending above, okay? Now, that's pretty much it. I know it is a complex idea at first for beginners to the entire options trading idea, but this is a very straightforward and simple approach to options trading, and it is a great way for value investors to keep honest and disciplined on where they want to buy their security and make some change in the meantime. So if you appreciated this video and you learned something, I would really appreciate if you could give it a thumbs up. I am a small channel, and I would really appreciate if you could drop a sub. It helps me out a lot. And if you have any questions, please just leave them in the comments below. I will be answering every single one. But until then, take it easy.